All right, guys, chapter 12, the equality of net exports and net capital outflows. You still don't know what that means, do you? Silly students. It's going to blow your mind. So a closed economy is an economy that does not interact with other economies. And we studied that for a while, even though there's not really a real closed economy on the globe, but we still taught you that. I suppose it's like a stepping stone. But I've got a few things that I've got to clarify in this chapter. One of the things is the supply of loanable funds from chapter 8. When we made the assumption that Canada was a closed economy that did not interact with other economies. Well, I got news for you. We are an open economy. We interact freely with other economies. And it takes two forms, that interaction. We buy and sell goods and services from other countries. We import, we export. But also, we purchase financial assets in financial markets, like bonds, like real estate, like businesses, stocks, mutual funds that invest in other countries. So anyway, so we buy financial assets in financial markets, and foreigners buy Canadian assets. And so those are the two ways that Canada is an open economy. All right, so what are some factors that influence exports, imports, and therefore net exports, right? Well, tastes of consumers, right? So sometimes the taste of consumers, hey, we want to get foreign goods for some reason, right? Or maybe it's Canadian goods that we want. We're proud to shop from Canada. Anyways, so taste from consumers can affect imports, exports. Prices of goods, exchange rates can affect that. What is our Canadian dollar, etc. Incomes of consumers at home and incomes of consumers abroad can affect whether or not they buy our products or not. The cost of transporting goods from country to country, policies of government towards international trade, all of these can have an effect on net exports. The last two there, the cost of transporting goods and the policies of government, are really the reasons why trade has exploded over the last 20, 30 years, right? The cost of transporting goods has really declined, and policies have realized the benefits from trade. So they set up free trade deals and they encourage a lot of trade. So the last two reasons are why trade has just been booming. We're going to be talking about the second and third reason here. In this chapter, we're going to be talking about the prices of goods and how the prices of goods can affect net exports, and also exchange rates can affect net exports as well. All right, so we'll be throwing around some terminology in this chapter. What does this terminology mean? Trade balance. Trade balance is net exports. All right? It's the trade balance. It's the exports minus the imports. It's also called net exports, okay? And when you have a trade surplus, it means that you are exporting more than you're importing, right? And when you are importing more than you're exporting, you're said to have a trade deficit. Okay, so you're importing a lot more. Goods are coming into your country, more goods are coming in, and you're buying foreign countries' goods, more foreign countries' goods than you are selling Canadian goods. That's called a trade deficit. And then balanced trade is when exports equal imports, and that's more for hypothetical purposes. But anyway, so let's look at Canada. What do you think? Does Canada have a trade surplus? Or do we have a trade deficit? All right, guys, so let's have a look. You can see here the orange line, that's total exports. Red is total imports. So you can see from about here all the way down to here, we were actually exporting more than we were importing. We had a trade surplus. Okay, and then from here to here, we had a trade deficit, right? And this is with all countries. But of course, our main trading partner, and you can really see this in the graph, right? So these two lines are United States and Canada, right? The purple one and the blue one. And you can see that when the purple ones and the blue ones go up and down, you know, the total exports and total imports also go up and down and down. It just shows how important the United States is as a trading partner for us, doesn't it? Right? And they really are an important trading partner for us. No doubt about it at all. But we can see in the last years here, I'll just put in red, but these years here, excuse me, but those years there, we have had a trade deficit, and and that same trade deficit has not been with the United States, right? And so what we can say that, you know, we've had a trade balance, I would say. I would argue at least since whatever 2008. Canada and United States have been okay. So, you know, 1 month we have a trade deficit with them. The next month we have a trade surplus with them. It's been pretty balanced at least, right? But our trade with the rest of the world over here on the top, and we've had a trade deficit with the rest of the world, and it's really three countries that we are importing more from than we're exporting from. There's been a change, and that's Germany, China, and Mexico. Okay, and we've been importing a lot more from Germany, China, and Mexico. Should we be worried about this? What do you think? Is the world falling apart? Oh no! All of our money is going to China. Is that a problem? We're going to examine this in this chapter. All right. So net capital outflow. Net capital outflow is because what we're really talking about here is we're going beyond goods and services. And now we're looking at the flow of financial resources, the flow of capital, the flow of money into other countries. So why do you buy assets in another country? Because I'm not talking about, you know, goods and services here. Why do I buy businesses in another country? Why do I buy stocks in another country? Why do I buy houses or invest in real estate in another country? Right? It's so I can gain some kind of return from that investment. Right? So anyways, so that's what net capital outflow is. Sometimes it's called net foreign investment. Okay? But basically net capital outflow is the purchase of foreign assets. Right? I'm talking about bonds, I'm talking about stocks, I'm talking about companies, I'm talking about real estate. Right? I'm buying assets in foreign countries, minus the purchase of domestic assets, Canadian assets by foreigners. All right, so there's two forms of capital outflow. There's foreign direct investment, and that's very active investment. In other words, a Canadian company is going out and investing in another country, opening up a store, for example, in Russia, and starting to sell products there, right? That's very direct investment. That's active investment. But foreign portfolio investment is like buying stock or buying bonds, okay? So, you know, it's like a Canadian buys stock in a Russian company, perhaps. Or you buy Russian bonds, 10-year bonds or 20-year bonds. That's portfolio investment, or mutual funds. I'm investing in a mutual fund that invests in Russian companies. All right, guys. So net exports, right, measures the difference between exports and imports. Net capital outflow measures the difference between the amount of foreign assets bought by Canadians and the amount of Canadian assets bought by foreigners. The difference between those. So if we are buying a lot of foreign assets out there, if we are investing in a lot of countries, that's net capital outflow. That's capital leaving our country. And by the same token, if we have a lot of foreigners investing in Canada, we're going to have a negative net capital outflow. Anyway, so what's the relationship between these two things, net exports and net capital outflow? Well, you guys probably remember the title of this video, right? So net exports equals net capital outflow, right? NX equals NCO. And how does this hold? How does this equation hold? Well, let's just take it by country to country. And maybe in order to remember this, you're going to have to do the same as well. Let's take, well, China. China is the easy example here. Because we know that we import more from China than we export from China. So in that case, our net exports is going to be a negative number. Am I right? We're going to import more from them than we export. Net exports is going to be negative. So we import all these goods and we export some goods to them. Now, when we import goods, when China brings their toasters and microwaves and stuff like that here, we give them Canadian dollars for those goods. We give them Canadian dollars for those goods. What can they do with those Canadian dollars? Well, they could buy more stuff. Yeah, I know, but I'm talking net exports. Okay, after all the buying and selling of goods and services is already done, net exports is negative. We import more from them. We buy more from them than we export to them. After all the goods and services have already been exchanged, they have extra Canadian dollars in their pockets. What are they going to do with those Canadian dollars? They're going to invest in Canada. It's the only thing they can do with that money. So we're going to have an inflow of capital into Canada. So the net capital outflow number is going to be positive or is it going to be negative? We're going to have money coming into Canada. So that's going to be negative. All right. So our net exports equals our net capital outflows. If we import $500 million worth of goods more than we export to them, they're going to have 500 million Canadian dollars in their pockets. What are they going to do with those 500 million Canadian dollars in their pockets? They don't want anything from us anymore. That's already finished. They don't want like any more goods or anything like that, services from us. After all that's said and done, they have $500 million Canadian dollars in their pockets. What are they going to do with that money in China? They're going to invest in Canada. They're going to invest in Canada. And I acknowledge, like, you know, the toaster company, you know, that they might exchange the money in China. That money might get changed hands a few times. It might end up in a bank, wherever, or an investment bank or something like that. But inevitably, those Canadian dollars in China will end up in the hands of a Chinese person that wants to invest in Canada. Net exports equals net capital outflow. All right, so net capital outflows equals net exports. The money leaving our country and being invested in other countries, right? That capital, the capital that leaves from Canada that's being invested in Europe and America and Asia, that equals our net exports. And so when we have a negative net export number, that means that we're going to have more investment in our country. We're not investing in other people's countries as much as they are investing in our country. So a lot of people think that, you know, if we import more than we export, that money's gone. That money that we're using to buy those Chinese goods or those European goods is gone forever. And it's not. it still comes back to us in the form of investment. Is foreign investment all bad? No. Foreign investment is good. I mean, we want foreigners to invest in our country, don't we? It's money coming in. Construction happens. Buildings are created. They buy stuff. They buy cars. They buy equipment. They buy supplies. They hire people. This new investment breeds further investment. There's a multiplier effect to it. Right now, our oil sands is hurting for a lot of reasons, but one of the reasons is that, there's been a divestment. Foreigners are getting out of the oil sands. Foreign companies are. They're selling off some oil sands assets, or at least they have been in the last 4 years. Moving it to other locations. We want some investment in our oil sands. China, for example, just look at the table here, owns 6% of our oil sands production and 7.3% of our oil sands upgrading. I remember when they bought Nexen, a Calgary-based oil sands company. Ooh, that might have been 10 years ago, for all I remember. But there was a lot of controversy about that, for sure. Nowadays, I think we would welcome any investment at all from China in the oil sands business. But, sometimes it does, there's some problems with it. I'll agree with that. Like, for example, real estate. China has been, we've been importing more from China for a long time than we've been exporting to China. And so China has been getting a lot of our Canadian dollars, and they haven't known what to do with it. And but people have managed, they're thinking, what am I going to do with these Canadian dollars? What am I going to do with these Canadian dollars? The government here in Canada in the past has not been so welcome about China investing in like oil sands or big projects like that for political reasons. I understand that. Some of that foreign investment into Canada from China has gone into the real estate market, like in Vancouver, for example, which has really increased housing prices in Vancouver, real estate prices. And not just in Vancouver, but in other areas. There's been a lot of Chinese, they love buying real estate. So they've been buying a lot of real estate. They send their kids to university here because they think it's a safe place to go to university. And they buy a house here. And maybe they will leave China someday just in case, and they will retire here. And so they've been buying real estate. But the problem with that is that it's been increasing the prices for real estate for Canadians. And the government, the British Columbia government, and the federal government has tried to deal with that. Vacancy taxes. Hey, if you're not living in this house, you're going to pay a 1% tax of the value of this house every year. If no one's living here, this is ridiculous. A lot of houses, really expensive houses in Vancouver, were sitting perfectly empty. Foreign investment. These capital inflows coming in. So it's not all great. I don't mean to say it's all great, but it's not like the money is gone forever. The money is not gone forever. When we import, when we buy something with our Canadian dollars, we buy that Chinese toaster, inevitably, what are they going to do with that Canadian dollars? It's going to end up being invested in our country, creating jobs, stimulating the economy. So the money is not gone. Anyways, so when net exports is greater than zero, right? When exports are greater than our imports, the country is selling more goods and services to foreigners than it is buying from them. What's it going to do with all the foreign money it receives from the sale of goods and services abroad? What are we going to do with all this foreign money? Well, we will start buying foreign assets with it. We'll start investing in other countries, right? Because capital is flowing out of our country into another country. And we're going to be buying their stocks, buying their bonds, buying their businesses, things like that. So when we have a trade deficit, our net exports are less than zero. The country is buying more goods and services from foreigners than it is selling to them. What are they going to do with all of our excess Canadian dollars? Inevitably, someone in that country will start investing in our country. Capital is flowing into the country. So net exports is less than zero and net capital outflows is less than zero. All right, so we all know Bombardier. Bombardier is a Canadian company. Let's say Bombardier sells some airplanes to a Japanese airline. We'll call it ANA. Bombardier gives planes to the Japanese firm, and the Japanese firm gives yen to Bombardier. Right? So exports have increased, and that raises our net exports. And Canada has acquired some foreign assets. We've acquired yen. What are we going to do with that yen? Can't spend it in China. Can't spend it anywhere else, really. Right? I mean, okay, so what are we going to do with this yen? Well, I admit that Bombardier will probably not keep the yen unless it is planning on investing in Japan, which I doubt it, right? Bombardier will probably not keep the yen. It'll probably exchange it with someone else that wants to invest in Japan. All right? And inevitably, it might end up in an investment bank. It might end up in passive investing. So maybe there's a mutual fund out there, and so an investment bank has a mutual fund, and then so they want to invest in stocks and bonds and things like that in Japan, and so they'll use the Japanese yen to do that. There's a lot of different things that could happen to that yen. But after all the goods and services have been exchanged, we're talking net exports here, right? After all that is said and done, what happens with the excess money? It's invested in Japan.